Hello and welcome back to The Note. Do fund managers pose a systemic risk to the world financial system? Now, regulators around the world have been asking themselves that question, and a number of them have said perhaps yes. They include the US Treasury Department and the Bank of England here in the UK. Now, my guest today is one of the world's foremost authorities on fund management, and he is suggesting that perhaps those risks are not as great as many might think. He is the head of research for Strategic Insight in New York, Avi Nachmany. Avi, thanks very much for joining me in London.
Thank you. It's a great day in London today.
It is indeed. Don't think it's typical. Now let's start by taking a look at a chart. This is a fascinating chart you've produced showing how investors in mutual funds have behaved over the last 20 years, comparing that with how the portfolio managers themselves behaved. Take me through what we're looking at here.
Well, I mean, first of all, it's an important question to ask. Clearly we are living in this semi-permanent state of investment anxiety. Fortunately, clearly, there's an opportunity to look at 50 years of history and identify the times of crisis. And this is an example, if you just focus on the October 2008, where portfolio managers and investors were facing a very scary time.
Yes, we really did think the world might be about to end, well, the financial world anyway.
Financial world, and sort of you look at the data, and sort of this is the test of extreme. The blue line, investors in stock mutual fund in the US took out 2%. Even in the most scary time, over 20 days, they took out only 2% of their stock investments, and portfolio managers, which is the red line, took out only 0.3% during the entire month, $3 out of $1,000.
Which is extraordinary. So basically, the average mutual fund has 1 or 2% in cash. Those cash buffers were more
4 to 5% more likely.
So those cash buffers turned out to be sufficient to absorb the entire selling by Joe Public.
Almost during this very scary time. And what's important to understand, it's not just one instant. You look at a pattern, whether in the crisis of '87 and subsequent years, it's the same pattern. In times of great duress, portfolio managers serve as a buffer against investor anxiety. And again, this is data go back almost 50 years.
Rather than an amplifier, which they might do if they were leveraged, if they had to make forced sales.
Exactly. And this is clearly, that's the way we think about the mutual fund experience in the US, where we have a lot of transparency. And I believe anytime you have a large number of investors, so I call it the heterogeneity of the mutual fund ownership pattern, every time the marketplace deal with a heterogeneous sample set, we saw that in the past, and I think we will see that again in the future.
Okay, now there have been some important changes to the way the fund management industry is structured, though, over those last few years. Most importantly, the introduction of ETFs, or the growth in ETFs. If we take a look at this next chart that you've provided, this is flows in and out of actively managed mutual funds compared to ETFs and index funds outside the US. This suggests that active managed money is very impatient, very skittish, or relatively very skittish.
It's evolving. It's evolving. Interest in emerging wealth regions, we don't even call them emerging market. I mean, I call it emerging wealth region. And the question is, as an investor, what do you do? How do you think about wealth creation over a long period of time? What we are seeing, the evolution of emerging wealth region, not just as a tactical, opportunistic investment place, but as a place for core, long-term, strategic asset allocation. The US has evolved further along those lines. Outside the US, we still see more often money comes in, money goes out. It's more evolving.
Right.
And the data clearly, we saw that before the '08 crisis and in and out after that crisis.
But this is fascinating. Now let's take a look at the same exercise within the US. And here it's the ETF money, which is impatient, most likely to head out swiftly in reverse, and the actively managed money that's relatively calm.
And that's where actively managed funds in emerging wealth region, again, are now used as a core long-term strategic asset allocation. And this is where we see during the last 5 years generally continuity of interest to expand your exposure to emerging wealth regions. Good time, bad time, it's now part of the core way of thinking about investing in the future.
Okay, but in the case of ETFs, is it fair to say they're a toy of hedge funds?
Clearly some owners of ETFs use them opportunistically, whether it's emerging markets or gold funds or other type of strategy. We see there's the long-term asset allocation versus the opportunistic investing, and ETFs is a place where you see so much more of the opportunistic investing pattern.
Okay, Avi, thank you very much indeed.
Thank you.
I still think there may be questions to ask about the systemic risks that fund managers cause, but plainly the argument from the last 20 years is providing there's no leverage involved, obviously a big point, but providing there's no leverage involved, they do not appear to have stoked the great systemic risks that we've encountered in the last 20 years.